Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. So thankful, as always, that you tune in here and give us just a few minutes of your time, where we just share some of our thoughts and things that we found worthy of sharing with you that we discuss in our weekly investment meeting. This week we got three things to discuss with you. We're going to talk about Japanese equities, not something that always comes to the front page, but share with you what's really been a long journey for Japanese stocks. We're going to take a look at the Fed. While no decision on rates likely at this meeting, very well could be some other decisions. We'll dive into that. And Andrew's going to cover the technicals and the 3-month new high trend. So let's start off with the Japanese equity. So if you're not familiar with the story, one of the great boom of all times, and basically any market, was the Japanese equities into the late 80s. All right, they just went on an absolute tear. And the interesting thing is they are still below those highs that they had over 30 years ago. But Japanese stocks have been strong the last several years and are finally, for the first time in over those 30 years, challenging those previous highs. From a portfolio perspective, there have been a lot of things to like about Japanese stocks, and in many of our portfolios, we've had an extra weighting or an extra helping of these Japanese equities, and have all the reason to believe they will continue, not in a straight line, maybe not this exciting that they've had the past 2 years, but slowly but surely regain that new territory and put that long era behind them. I also think it's noteworthy that we have this notion that equity markets always come back. They tend to, but it can take a long time. And as the Japanese equity scenario here shows you. So let's move from Japanese stocks to U.S. here and look at the Federal Reserve decision they have in front of them. Rates have all the focus, whether it's the Federal Reserve raising interest rates the last couple years, or when and how fast and how much they will cut rates this year. Our rates are usually the biggest decision, but behind the scenes is the size of the Federal Reserve's balance sheet. Starting in 2008 and then again in 2020, they very aggressively accumulated assets, buying up all sorts of bonds, particularly United States Treasuries as well as mortgage bonds. They have accumulated what was used to be about $1 trillion on their balance sheet, have swelled that up well over $5 trillion, and they have been slowly trying to work that down. In 2023, it accelerated, and they allowed a little bit more of these accumulated assets to roll off of their balance sheet. This does have many market expectations. I believe this allowing the Fed to step away is one reason why we've seen mortgage rates be particularly stubborn. If you look, there's typically a spread between where U.S. Treasury rates are and then what winds up on mortgage rates. They have been a little bit extra, and this is one reason why, because the big buyer of the past several years, the Federal Reserve, has turned to a net seller. So one of the decisions they have here, and there was an article in the Wall Street Journal today, which is often where the Fed kind of leaks some of their news, that they may begin to stop some of the selling, which is called quantitative tightening. So we will see on that. It could bring some relief into mortgage rates. It's no done deal, but it usually is a good precursor that's where the Fed will follow suit. So all eyes are on that one. It's not always clear which direction overall rates follow these big portfolio Fed balance sheet decisions, but it certainly does send waves of liquidity or liquidity coming out of the system, and something we'll be paying attention to. So Andrew, we'll shift one more time from kind of the economic side here and go to the technicals.
Yeah, thank you, Adam. So one of the topics we often discuss in our allocation meetings, and one I often bring to you all every week in these market carvers, is looking at the breadth of the market. And as a reminder, that simply just means the level of participation of individual stocks. Instead of just looking at the indices, we also want to know how individual equities are performing. When we're in a stronger uptrend in the market, when the S&P is hitting new highs, in fact, like last week when it hit a new 52-week high, we then want to stop and say, okay, how much participation are we seeing from an individual stock level? Now, it's very encouraging that we're seeing the index be so strong. We're not quite back to all-time highs, but we did see 52-week highs. And so looking below the hood and looking how individual stocks are performing, it's a little less encouraging. Unfortunately, chart we're going to put on the screen now and show you looking at the 3-month high list for large cap stocks. So you can see if we look back last summer, we can see we started seeing less and less stocks. You can see the kind of the dotted diagonal line. Less and less stocks were also making 50 or new 3-month highs. And then we saw the market very slowly see about a roughly 10-12% decline. And here recently, we saw a lot of really strong price action in the market. A lot of stocks were really rising as we moved into the end of 2023. In fact, if you look at the very kind of the far right side there, almost half of the stocks hit a 3-month high towards the end, towards about mid-December. Unfortunately, that's when things started to kind of turn around. We saw a little bit of a pullback in January, and as the market recovered, the indices recovered, less and less stocks were showing the same type of recovery. Instead, we were starting to see a lot of just the mega caps. We often talk about the Magnificent Seven on these videos. They were really the primary driver for that most latest bounce higher. And so we're starting to see a decline in new 3-month highs, which means while the index has recovered, a lot of the stocks are starting to not show that same type of strength. They're more stagnating. And I say stagnating instead of declining because we look at the bottom part, we can see we're not really seeing a lot of new 3-month lows either. So that's encouraging. That's still a positive. We might not seeing stocks ripping to new highs, but they're not dropping to new lows either. So we are encouraged by that. What this tells us is we could start seeing the market pause or begin to consolidate, pull back a little bit, which is very normal, very healthy. We can't expect every day to be a new high for the rest of the year. And so seeing some type of consolidation digest some of the really strong gains from the end of last year and the new highs we're experiencing at this far into January would be healthy, would be normal, and would make sense as we're starting to see less stocks, or a lot of stocks are already starting to do it themselves. So we should start seeing the index maybe do it as well. So we still have a long term, the breadth still looks really good. A lot of stocks still are in solid uptrends. We still have good sector strength there as well. So if we do see a pullback, we don't think it's going to be very severe unless that data starts to change. But for what we can see right now, setting up a small pullback would be normal, would be healthy, and would confirm what we're starting to see on the individual stock level, looking at the data we brought today at 3-month new highs and 3-month new lows. So we'll see going forward if we do start to see some consolidation. And again, once we start seeing that those new high lists start to improve, that's where we're really going to be encouraged. Start seeing a lot more stocks rising like we did at the end of last year is the type of action, the type of participation we're looking for.
All right. Thank you, as always, Andrew, and thank you to all of you for giving us a few minutes of your time here. As always, we'll give you a reminder to give us a call if we can be of help, 800-928-4001, or scan the QR code and book it electronically. So thanks again. Have a great weekend.